Jaspreet Arora is here with us. Jaspreet, afternoon. Thanks for your time. Jaspreet, the market at a record high. There is some churning happening. Banks seem to be taking a bit of a breather, but rural-centric stocks are coming back. Be it FMCG, soft commodities retreating, also helping them. Hero Moto, again a rural-specific stock, come back. Do you like this pocket on valuation front?
Hi, Ajay, and good morning to ET Now and all the viewers. And thanks for inviting us. We're not very big fans of this space. We are more into the we like the pockets, where you have a discretionary expenditure or semi discretionary expenditure. So FMCG, rural, they have its own cycles depending on monsoon, inflation, the rural wages, and as you said, the inflationary tailwinds or headwinds. Very difficult to make money over a long period. So we are not very much into this space.
Tell me what exactly interests you right now in terms of valuation comfort versus the earnings growth, something market may be ignoring right now.
Sure. Yeah, the consensus obviously is financials, and within that, the pecking order would be banks, followed by NBFCs, and then the non-lending companies, be it broking or depositories or on the AMC side. This would be followed by the next bucket where we are extremely positive or extremely overweight, which is a consumer discretionary basket. And there you have tons of mini pockets and segments, be it footwear, apparel, retail, hotels, multiplexes, QSRs, Alcobev, paints, building materials. You just have to. There are tons of companies, and a lot more are waiting to come to go public. That's the very and that is a pocket which will benefit to a great extent when we move from that $2,000 per capita to a 4,000, 5,000 over the next couple of years. So this is the space that we like after financials, and we are extremely overweight. And the last piece, or the number third in the pecking order, would be again manufacturing. And again, the likes of the electronic manufacturing companies or chemical companies, paint companies, wherever there is a manufacturing which is a mix of domestic plus exports, and also there's the opportunity where we could that company or that sector could displace China and even Europe for that matter, which is the next big thing that's being spoken about, which is Euro plus one. So these, I would say, BFSI, consumer discretionary, and the last bucket of manufacturing, which is interesting to us. What's not as much interesting is or we are not as positive is or we would be equal with would be the spaces of, let's say, auto, pharmaceuticals, and IT. And the other large bucket of oil and gas is not something that we are very positive, and we don't invest as much on that space. Ajay?
Jaspreet, what about materials like cement? They had a bad quarter, and the expectations are that this quarter onwards, the December ending quarter onwards, margin pressures may have troughed out in the previous quarter. Any names you like there?
Absolutely, bang on. And you make money when the bad news is over, and the incremental news is more on the positive side, and which is what is expected to come out in the cement space over the next couple of quarters, because petcoke stroke coal prices are very close to the lows of multi-month, multi-quarter lows. At the same time, we're now hitting into a good season, which is a peak construction period. And lastly, the cement prices we hear have gone up 8 to 10, and even some pockets 15 rupees in the last couple of weeks. What we like here are only two names. One is the behemoth, which is Ultratech, given the size, the scale, the parentage, and also the diversity which it offers in terms of the revenue split across grey, white, and putty, and other smaller pieces. And the other name that we like is JK Cement. So far, we are only having our investments in either one of these, not both of these, in either one of these portfolios, depending on portfolio to portfolio. Ultratech and JK Cement would be our picks here.
Great. What about the manufacturing theme, Jaspreet? Do you like, how are you exactly playing the manufacturing China plus one, Atmanirbhar, towards the manufacturing side? Do you have anything in that portfolio?
Yes. So, we have companies exposure towards spaces like automobiles. Let's say, a company like Escorts Kubota, where again the export angle is not big today, but it could open up the way. We've had this analyst meet recently where Kubota spoke about how they want to increase global outsourcing from the Indian unit. So something like that. The another example could be Dixon. Again, it doesn't need any introduction or positives. It's the way they have grown so much, and now with incremental news that's coming out of China, where a lot of factories, including the likes of Foxconn shutting down, and even Dixon's trying to get new clients added in mobile and so many other verticals. That's another name which is definitely right at the top. And also something like a auto ancillary like Sona Comstar, where again where in it's making its inroads into being the one of the leading auto ancillary company, which is trying to grab orders across Europe and US. Suffice to say, a disclaimer: these would be investments where we would have vested interest. Our client would have put investments in the last couple of years, last couple of quarters. Yeah, so these would be some of the names that we would have exposure, and obviously a little bit of on the chemical side. So some of the names that we are positive within chemicals are Sumitomo and Tata Chemicals and Deepak Nitrite and Naveen. So again, we don't have all of them in, but across portfolios we would have one or two of these. So Sumitomo, Naveen, Deepak, and Tata Chemicals.
Right. How are you analyzing the valuation of the small and mid cap basket? Because that has not really moved at all compared to the large cap universe.
Yeah, I knew this was coming. This has been a pain point, and I don't think you would have any interview on any day without discussing this point. So looking at how Nifty is done in the last 1 year, plus 9%. The mid cap is plus around 8%, while surprise, the small cap index is down 5%. Now that is where a bulk of the retail money is, right? And when you see the index at -5, and I'm sure, assuming half the portfolio is small cap, the weighted average return would be either negative or very close to flat, while Nifty is up almost 9%. What we analyzed and checked over a 3, 5, 10-year period, it's actually the mid and large cap. If one has a larger portion to mid and large cap, that is enough to outbeat the Nifty. While having a reasonable or small exposure to small caps is sufficient, and that is what we are trying to do here as well at Research and Ranking. So our exposure towards large cap would be between 40 to 50%. The mid cap would be 30 to 40%, and last 15 or max 20% would be small caps. There are opportunities. When you look at Nifty, the upside seems limited because at 18,500 Nifty, when you look at the earnings for FY24 at 1,000 rupees odd, it seems to be very close to the fair price. So maybe another 5-8% upside more over the next 3 to 4 months.
Final